And we are 30 minutes into the trading day, and you see the S&P 500 lifting a little higher, about 0.25%. The NASDAQ 100 getting a little more love at 1/3 of 1%. The 10-year yield getting a little bit of relief, 2 basis points lower. Welcome to Bloomberg Open Interest. I'm Shonali Basak.
And I'm Romaine Bostic. Matt Miller and Katie Greifeld are off. Shonali, you're stuck with me for the next hour.
But I'm looking forward to it because we have a lot of economic data. We have a lot of earnings data. And coming up, we're going to talk about some of it. Retail sales are sizzling as Americans keep spending, Romaine.
Absolutely. And we're keeping an eye on Netflix taking the spotlight as earnings season ramps up.
And Jerome Powell's fate hangs in balance. Apollo's chief economist Torsten Slok weighed in on the Fed drama.
So a stagflation shock is by definition that inflation will go up and GDP growth will go down. But if you fire the Fed chair, as we saw yesterday, the dollar will likely go down. And at the same time, long rates will be going up. And the dollar going down is certainly inflationary. But rates going up is, of course, holding back growth. So firing the Fed chair will probably mainly mean a decline in the dollar and an increase in long rates.
Now, former Bridgewater chief investment strategist Rebecca Patterson agrees. She writes, quote, even if the American economy and financial markets are strong enough to moderate the impact of the Fed's tarnished reputation, the directional response seems clear. Higher long-term borrowing costs for households and businesses, and a weaker currency that would support inflation. Rebecca Patterson serves as senior fellow at the Council of Foreign Relations and joins us at the desk now. You know, you look at the rhetoric that has been coming out of Washington, the president himself, but also allies of the president, if you will. You look at Kevin Warsh just this morning as well, speaking about, yes, maybe the need for an independent Fed, but the missteps he thinks that exist at the Fed. We know he is one of the names under consideration. Now, the Treasury Secretary says this shouldn't be confusing, but is it?
It shouldn't be confusing to whom? I mean, if you're a global investor and you're trying to decide what is the right yield on the 10-year Treasury or the 30-year Treasury, the possibility that the Fed is politicized, how much risk premium, how much extra compensation should be in that yield if there is some probability that the Fed could lose a measure of independence. So I think it is confusing for a lot of investors. Is this just talk? Is nothing going to happen? Or is there a real threat here, especially because Powell could be fired if some group of senators, congressmen, et cetera, are able to make a case to the president that there's cause?
Criticism of the Fed is not new. What it does seem to be new is what is clearly a coordinated effort to try to undermine Powell's credibility, presumably in hopes that, you can get him out of there before his term ends. And I do wonder if the damage might already be done. I mean, this has been, when you think about the United States of America as a place to invest, a lot of people look to our stability through the lens of really two agencies, the Fed and probably the Treasury to a smaller extent. And now you have a coordinated effort to potentially undermine that. And I'm just a little confused as to why.
Well, I do think President Trump wants lower interest. I mean, obviously, he wants lower interest rates, but he wants them because it'll help finance the debt, which is getting bigger thanks to the big, beautiful bill. And he wants to bring manufacturing jobs back home and increase exports. And a weaker dollar that would come with lower interest rates would help do that. So there is an economic rationale here. There might be some personality rationale as well that, when he wants to get rid of people who he believes serve him, and he's not able to do this one as easily. So there might be that there, but that's speculation. I do think, even if President Trump gets his wish and he gets a new Fed chair at some point in the next year, even if it's without firing Chairman Powell, that person is going to have a horrible situation to come into because their credibility is going to be immediately questioned.
Why not just keep quiet? We're talking 10 months from now. I mean, you could have just kept quiet for 8 or 9 months, put your nominee out there, not said a thing, and the perception would have been so much different than what we're going into right now.
Well, I mean, is he trying to protect himself from potentially different economic conditions moving forward so he could blame the Fed?
That's possible. Yeah, that's possible. But to your point, I think you're 100% right. There is going to be a seat opening up in January. And so the president can nominate who goes in that seat, and the Senate presumably would support that person. And so that person could be elevated to chair next May when Powell's chairmanship ends. So they have the ability to make that move now.
When you look at the contenders, at least the ones that the media seems to be reporting on, Kevin Warsh, Kevin Hassett, I guess Waller to a certain extent, and I think Scott Bessent's name has even been thrown in there. Who would you want to see amongst that slate?
I mean, they're all experienced. They're all incredibly bright people.
Yeah.
Again, that's the challenge. Even if I think imminently qualified, now I'm going to be wondering, are they making this decision or pushing for a decision? Again, you need a majority vote within the FOMC. Are they doing it for the right reason?
Does it matter that some of those people I named seem to be actively campaigning for the job publicly?
Well, it just means that financial markets or investors are parsing those comments to try to gauge what they would be like if they were chair, to see what kind of steps could we expect. So Kevin Warsh on another program this morning talking about a new Fed Treasury Accord. The last one was created in 1951 to give the Fed more independence. So if we want a new accord, what does he mean with that? Or if the Fed's independent, but we need to be focusing on borrowing costs, does that affect QE, QT? Like, where are we going with this? And I think now that you have people very vocal about their desire to help drive the Fed forward, we're going to be parsing every single thing they say, and that's going to influence markets, and it could create more volatility.
We're showing here poly market odds as well, which I find have been very interesting, and more traders following them kind of closely here. But I do want to talk about real world implication also, because you do see the economic data still coming in strong. You see Bitcoin hitting 120,000. You see SPACs flying into the stock market once again. Is there a justification to start cutting rates this year, given where the economy is, even just on the data we're seeing right now alone?
Yeah, so there are signs, lots of signs, that the economy is moderating. Despite the strong retail sales we had this week and slightly better guidance from some of the earnings we've gotten out from the banks, especially saying the consumer's okay. But if you look at the latest beige book that the Fed produced yesterday, it was showing almost every district seeing a moderation in growth, more pessimism about the outlook, and importantly, rising prices. So if I'm sitting at the Fed and I know August 1st, there's the potential for tariffs to go significantly higher. I know from surveys of CFOs that they're planning to raise prices. They're saying we're going to raise prices in the coming months, but growth is moderating, but from a good place. I'm not cutting rates. And yes, the Fed cut rates last year, and they're not cutting this year because we're in a totally different place. And last year, real interest rates were significantly more restrictive than where they are today. So they were trying to get a little less restrictive last year. They don't need to as much now. Rates are absolutely lower.
So in your view, there's not really an economy to be saved right now in terms of coming to the rescue. I guess the question, though, too, is, and if you look at the administration's argument, the idea is that they do want to see more stimulus for this economy, whether it's from fiscal policy or monetary policy. Is there a case to be made for some degree of a bump, not so much just for the short term, but the idea of keeping things going, and maybe you lay the groundwork for that with, I don't know, 25 basis points, 50 basis points of cuts?
So if inflation could come down further, right? Headline CPI, which I know isn't the gauge, but it was 2.7 this last month. So it's still quite a bit above where we want to see it, for even for core PCE, for the Fed's preferred gauge. If inflation kept coming down, even though growth was strong, the Fed might want to take a little more interest rates off the table just to get less restrictive and try to engineer that beautiful Goldilocks. But we need to see inflation come down, or we need to see the labor market worsen, and it might, but it hasn't yet. So I think right now it makes sense for the Fed to be sitting on his hands. Is there a risk they're late? Yeah, there is, but it's a lot easier to do a couple quick rate cuts than to have to cut and then raise rates again.
That's a good question. Is it better to be late, or is it better to be early?
Well, it's better to be perfect, but if
you sound like my mother.
If you're cutting late, where they are right now, they can cut they can do 50, they could do 75 basis points. So they could catch up and send a signal to the market pretty effectively from here if they needed to.
Rebecca, I think a lot of the reason investors are watching this tit for tat so closely is the Federal Reserve has played this massive role in a few ways. Yes, of course, interest rate setting, but also that idea of a Fed put, the kind of role that the Fed has in saving the market if things go awry. So if you have to prepare yourself for what the Trump administration's influence is going to be on the Fed moving forward after a new chair exists post Jerome Powell's term, what is the implication to the market itself?
That's my next op-ed. That's a great question. It's a great topic. I mean, on one hand, again, it's a majority vote at the Fed. So even if you have 2 or 3 or 4 members of the FOMC, the voting committee, who agree with the president, it doesn't necessarily mean you're going to get what you want in terms of a put. At the same time, I think you could take it the other way. So if we're politicizing tariffs in new ways that we never used them before, for Brazil politics, for gosh sakes, what's to say we couldn't politicize Fed swap lines? If a country wants our help in a crisis, and the Fed historically has provided dollar liquidity, could we now do that just for countries that pay their fair share? I mean, so I think politicizing the Fed could have a number of different real-world implications, back to your comment, that we haven't even processed yet.
Yeah, this is amazing. And your last column, by the way, thanks for helping her with her next column. But your last one, that 35% we're talking about. I know you drew a lot of parallels to Hungary and Turkey. We're not headed down that road.
No, of course not. America is still exceptional in so many ways. I was just trying to show parallels where governments eroded central bank independence and the impacts they had. In every single case, it was higher long-term borrowing costs, even though you had shorter rates lower and much weaker currencies. And I think in the United States, even if the degree would be much, much smaller, I think the direction would probably be the same. And we've seen it as well. It's not just emerging markets. We've seen that in Japan. We've seen that in the UK and within the U.S. in the 70s. So we have enough examples that we know what we're asking for here.
Yeah, absolutely. And it's a great column. I definitely expect everyone to check it out. Rebecca Patterson there over the Council of Foreign Relations, formerly at Bridgewater, as we keep the show moving with a closer look at some of the big stocks moving this hour. That includes TSMC. TSM, the ticker, a boost in its sales growth forecast as AI orders, at least for now, seeing no signs of a slowdown. UAL, United Airlines, getting a pretty modest bid on the day after it narrowed its profit range. The initial reaction was to the downside, but the CEO speaking with Bloomberg just a while ago saying that the airlines might actually be excluded from tariffs, and that gave a nice pop to the stock. And PepsiCo, that is your main leader in the S&P 500 right now, thanks to strong international demand.
Interesting. Still, though, down almost 5% on the year. Let's see if it gets flat. Let's see if it plays that Coca-Cola catch-up.
Are you a Pepsi or a Coke person? Or do you not care? Okay.
Neither. I don't do soda. Come on.
Okay. Excuse me.
But too much coffee.
Are you like one of these you and Tim Senevic, like two healthiest people in this building?
Yes. And also interesting, coming up next, we're going to talk about another big mover in the market, Lucid just soaring, looking at a reverse stock split and pairing up with Uber on robo-taxis. We're going to bring you more on that story next. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. Shoppers snap back. U.S. retail sales rebounding in June after the White House dialed back high tariffs. Consumers appeared to temporarily shrug off trade wars, and they've spent more on cars, on clothes, on dining, and do-it-yourself projects. The report offers some relief around mounting anxiety around the health of the U.S. consumer. And President Trump said that he would send letters to more than 150 countries, notifying them that their tariff rates could be 10 or 15% as he forges ahead with his trade agenda. In recent days, Trump has unleashed a barrage of tariff demands, informing other economies of new duties that would kick in on August 1st if they cannot negotiate better terms with the United States. And Union Pacific is reportedly working with investment bankers at Morgan Stanley to explore an acquisition of an unknown rival. The Union Pacific CEO is on record saying that a transcontinental railroad merger would fuel growth and improve service, but neither Morgan Stanley nor Union Pacific are commenting. Romaine, this is a market that is in love of a story around M&A.
Absolutely here. And well, not quite M&A, but the story that the market's in love with this morning involves Lucid. The share is up about 30% after we learned that Uber is actually teaming up with the EV maker and the self-driving tech startup Nuro to launch a robo-taxi fleet. Ed Ludlow joins us right now, the co-host of Bloomberg Tech. And Ed, I guess it's not surprising. We know Uber has made a lot of moves in this space with regards to autonomous driving. But talk about the difference in what this type of deal with Lucid and Nuro compared to maybe the types of deals that it already has with Waymo and Volkswagen.
Great question. It's in line with Uber's broader strategy, but it's a three-way deal. Lucid provides the vehicles, Nuro provides the software, Uber basically finances and pays for everything. It puts $300 million into Lucid so that they can update and retool the assembly line to build vehicles, Lucid Gravities, that accommodate autonomous hardware. Nuro integrates its tech in Lucid's facilities. Starting in 2026, separate from that investment, Uber buys a minimum of 20,000 Lucid Gravity SUVs. So that is completely independent. It's actually, noting the move in Lucid shares, really interesting revenue, guaranteed revenue for them. So at the end of 2026, when they start production, over a period of 6 years, Uber takes delivery of a minimum of 20,000 of these specially retrofitted Gravities, and then operates the robo-taxis on its platform in the same way that Uber operates Waymos on its platform, but doesn't have any responsibility for the manufacturing or capital expenditure of the vehicle itself. This is slightly different because Uber's buying those vehicles directly from Lucid.
How important is this to Uber? You're not seeing, of course, you were seeing a very significant year-to-date appreciation of its stock, but today they're not biting as much. Why is that?
Well, because if you do some basic maths, we don't know what the per unit price of a Gravity will be, but let's say it's $75,000 and they've committed to buy 20,000 of them. That's $1.5 billion of purchases they got to make right there. And it's a minimum commitment. So it's expensive for Uber, even though it's kind of not taking on the burden of manufacturing the vehicle itself. It's not an OEM. Also, Uber's kind of spreading its strategy pretty wide, right? It has a number of partnerships in a number of jurisdictions on robo-taxi, almost hedging its bets a number of years after it gave up on its own sort of pure play robo-taxi strategy. So that's kind of interesting. It's not full stack. You compare with Zoox or Tesla, where they own the technology, they manufacture the vehicles, they own the software, and then they operate the robo-taxis through proprietary ride-hailing. Uber just operates the robo-taxis through ride-hailing. It doesn't take on the other burdens of the tech stack and the manufacturing of the vehicles. So it's interesting.
Hey, Ed, I want to get your thoughts here on another aspect that's going on in the tech industry today, and that involves chip stocks. You're taking a look at TSMC. It's a market cap crossing the $1 trillion threshold, a relatively bullish report and guidance, and it seems to sort of ratify this idea that AI spend that, of course, everybody's been obsessing about and everybody's worried would slow down, at least for right now, it's not.
It's intact. Like, the majority of TSMC revenue is GPUs or AI accelerator cards that go into data centers of training AI, proportionately so far ahead of smartphones, which is TSMC's legacy. They've maintained this capital expenditures guidance, which gives the market a lot of confidence. Super interesting, and maybe this is a bit sort of in the weeds, but FX is a really important factor here. TSMC is like this global giant, but it's also the crown jewel of Taiwan. It books its revenue in dollars, but its operating expenses are all in Taiwanese dollars. And what it warned us was like, actually, that's going to hurt us. Margins were super impressive in the period gone, beat expectations, but later in the year, when you take into account that currency headwind, margins will be impacted. Find that so fascinating, a company that's like so entrenched in Taiwan, but as you guys know, investing heavily in the United States as well to build out its facilities here and bring capacity onshore to the US.
Ed, when it comes to the earnings season for the big tech giants, I want to talk about Netflix a little bit because, of course, it's not a Magnificent Seven stock. It has just been soaring this year. Ahead of earnings, you see the stock up another 0.6%. What are the expectations? There's been a question of, can it keep this run up? But you look at the content slate, and it seems like people are willing to pay for the goods.
So shameless plug here, and I'm looking down at my screen because I just sent my team the scripts for our show and tried to pack as many puns into the Netflix preview as possible. The reason being is we won't have that subscriber growth metric, right, or subscriber count. Netflix has always said, look at us as a traditional company the way that Wall Street should do, top and bottom line, and other metrics, net income being one. But you also need to look at some of the mechanisms they have. If they won't tell us the number of subscribers that they have or how it's growing, what are they doing to boost the top and bottom line? And price hikes is a really key feature for Netflix in various jurisdictions. The FX consideration is important here. But as I joked with Romain earlier, like, I'm just all about Squid Game right now. I just finished the 3rd season last night. So the content slate for the second half is so important. Like, it matters. Do they have some cool stuff to watch? What do their peers in streaming have to watch in the second half of this year? Believe it or not, when I get done in this place, I go home, I have like an hour or so to stream and watch TV. Netflix has some competitive offerings.
You're not watching Mr. Robot? Even some of the older shows are pretty good to return to right now, Ed.
No, I'm all about Squid Game, and then if I'm lucky, I just started watching. Yeah, I'm all about Squid Game.
I love this. You know, Ed's a new father, so in a few, about a year's time, your viewing habits are going to change in a pretty tremendous way, Ed Lolo. So
enjoy it while you can.
I hope you like silly little songs and dancing around.
Baby Shark.
That's all you're going to be listening to for the next 5 or 6 years.
Ed Bloomberg Tech co-host Ed Ludlow. We're looking forward to breaking it all down for us. And still ahead, it's still early days for Netflix's ad business, giving it multiple levers to create value as the media landscape evolves. We're going to discuss this with the CEO of e-commerce analytics firm Micmax. Stick with us for Rachel Tipograph next. This is Bloomberg Open Interest.
The S&P 500 opening at a record high on the day, but giving back some of those gains as we start to get deeper into the session. A big lift today from NVIDIA, Microsoft, some of the big tech names, as well as from some of the big consumer companies as well. That includes a big move higher, up 6% for Pepsi here on the day. A drag in other spots of this market, but when you take a look at the GRR screen and you look at the 11 individual sectors, 5 of them leading the charge right now. But again, a big weighting right now to consumer staples, a big weighting to industrials right now, maybe on the back of some of the big bump that we're getting from UAL and some of the other spaces in the travel space. Shonali.
Very interesting mixed earnings season coming up, but a lot of signs that are promising too, especially from the economic data. Retail sales surging as consumers spend more dough on dining out, or at least rising more than Wall Street had expected. We're going to talk consumer appetite with OpenTable CEO Debbie Su next. Stick with us for that conversation. This is Bloomberg Open Interest. Now, U.S. retail sales rebounded in June despite anxiety over tariffs and the state of the economy. Consumers spent more on cars, clothes, and dining. Let's get a read on the consumer with OpenTable CEO Debbie Su. OpenTable helps to fill reservations for more than 60,000 restaurants, bars, wineries, and other venues worldwide. Debbie, you look at the data, and I'm wondering what your data actually says. What are the types of consumers that are able to withstand the pressure of this economy to the extent that pressure exists.
Yeah, so we're seeing, even with the economic uncertainty on the macro level, that people continue to go out and dine. They prioritize their discretionary income on dining out. And we're seeing it all across all price points on our install base. And we're actually even seeing for the $50 per person and up, that's growing year over year. So despite all the news out there and the pressure we all may be feeling, people continue to want to go out to restaurants, have a good time, enjoy good food. And I think people who are watching, and even for you two, you go out, restaurants are largely full and busy, which is great.
Yeah, well, especially in this city.
Yes.
Do you see geographic differences, though?
Oh, for sure.
Yeah.
I mean, New York, as you alluded to, is historically very slow. Like, everyone somehow just escapes the city in the summer. But actually, even this summer, we're seeing New York is actually up 8% year over year in June, which is great to see. And we hear it from some restaurateurs here, too, where it's like, we continue to, it's up, which is great to see. But we also have other cities like Houston, Chicago, up double digits. Chicago's up, San Francisco's up 9 digits. So we're seeing that, I don't have a crystal ball, and I hope it holds, but it's wonderful to see this flurry of dining activity happening through the summer.
As you start to see this activity, I mean, how much information do you collect? So if I go through your site and I make a reservation for a restaurant, how much of that data about me, about my dining experience do you get, and how do you leverage that to build up the business?
We really get whatever you decide to give us, right? So if you want us to know your birthday and your allergies and your anniversary, and you want us to pass that through all the restaurants you dine with.
My birthday's on Sunday, by the way.
Oh my goodness, happy birthday.
Thank you.
Do you want me to put it in open table?
Well, I'm just letting Shania know. So,
he has the best. I can't keep up with your restaurant. He's much cooler than me.
Wait, do you know where you're going?
My wife has a big surprise.
Oh my goodness. Okay, well.
That I've already figured out.
Have her text me if you know. But anyways, so if you as a diner want to share that data, we will share that wealth of data for the restaurants, because restaurants love that data, because they can provide a great hospitality moment when you come in on Sunday. Happy birthday, Romaine. They know what you love to eat. They know what your allergies are. But it really is up to the diner how much you want to share. But once you do share it and give us permission, we try to arm restaurants with that information so they can provide amazing hospitality to their guests.
Okay, if I'm not mistaken here, all the New Yorkers that are leaving might be going to the Hamptons, and I think that they're paying for maybe what is going to be soon $100 lobster salad at Doria's. And so, it's amazing, because what we're talking about here is a worry about also a K-shaped kind of recovery here in this economy. But even on kind of the lower income side of things, it's interesting. You're seeing casual dining still outperforming quick service. Why is that?
Yeah, I think after the pandemic, when restaurants were largely closed for a period of time, we missed it. People go to restaurants to get a good meal, whether that be at the lower price point or the higher price point. You go there to get taken care of. You go there so you don't have to cook at home and shake up the week a little bit more. So I think, again, even wherever you land on the spectrum of income, you still want that experience, right? And so you prioritize that spend when you look at your household budget, which is great to see. And we love that for restaurants, because as you know, and I've come on and talking about it, it's a really rough business. It's hard running a restaurant. They run on laser thin profit margins, and then with all the labor shortages, supply chain issues, inflation, and there's nothing more expensive than an empty seat. So as much as OpenTable can be helping diners discover restaurants, fill restaurants, make them more productive. That's what we're here to do.
You want to know how hard it is to run a restaurant? We're talking about content today. We're watching the latest season of The Bear.
Absolutely. I mean, and it gets to this idea, though, too, that when we talk about that data, when we talk about the restaurant experience, I know you guys have deployed some AI tools. We were talking during the commercial break about the partnership you have with regards to the Chase Sapphire car and potentially having people get points, which I would assume would maybe engender more loyalty not only to OpenTable, but maybe even potentially for the restaurants themselves.
Correct. Yeah, we've been on a flurry of activity at OpenTable. So we this week launched Concierge, which is an AI-powered search bot. So if you land on a restaurant profile page and you want to know, are there gluten gluten-free options? Is it kid-friendly? Can my dog come? You know, like there are a variety of different questions, and the chatbot will give you the response. So far, engagement is great, and the answerability.
And the
is
chatbot
really
won't get
strong.
upset with me because usually when I go out, it's like 6 people and everyone has different. There's like 6 different dietary restrictions.
Yeah, but you could put all of that
so,
in. You know, my
okay,
mom doesn't like shrimp, but she likes lobster. And my, whatever it is.
Yeah.
So we launched that. That's really exciting because we know that people spend so much time, on average, 20 minutes to learn and discover a restaurant before they decide to book, right? So we're trying to help make that a lot easier. As you mentioned, we're doing a lot of partnerships. We recently just announced a partnership with Chase. They have done a relaunch of their Chase Sapphire Reserve card. OpenTable is part of that. So if you dine at an OpenTable restaurant that is within the Chase Sapphire
Is that going to
program.
help me get into like the hard, like, because in New York, I mean, you want to go to Tatiana, Teresi or something, basically I have to tell them I'm Tom Keane to get in the door. That's the only way they even take my.
It will help you get in. If you have the Chase Sapphire Reserve, there will be primetime inventory that is reserved just for you, Romaine. Right, so at places like Don Angie or San Savino, right, you'll get access to some time slots that people who do not have the card get access to. And you also get statement credits. There's a whole host of benefits.
When JP Morgan hiked the fee of the Sapphire Reserve card, $795, it made it one of the most controversial moves actually in the industry. You're paying more, but you should be getting more, and OpenTable is a big part of that, right?
Correct.
What are these credit card competitions really doing to the industry? And are they giving more and more back to the consumer in a way that makes it easier for them to ultimately dine? How do you quantify the impact?
I think the benefit to the consumer is clear, right? You pay a fee and you get statement credits or access to things that you wouldn't normally get. But from where I sit, I actually think the benefit to the restaurant is cooler. Right, as we said, it's tough running a restaurant. And so as much as we can be funneling resources and money back to them, right, a lot of these credit card companies are paying top restaurants for the privilege of access during prime time. And that money is going straight into restaurateurs' pockets. So that's actually what I really love about these types of partnerships. It's great for the consumer, but one could argue that the consumer who's willing to pay $800 for a credit card is going to be in decent shape. What I love about it is that it's like diverting or funneling more into restaurateurs' pockets.
Yeah, and obviously they need all the help that they can
That's
get,
right.
even the high-end ones. Debbie, always a great conversation.
Thank you.
Great to have you. OpenTable CEO Debbie Su there. Sonali, your name opens doors, right? Can I just drop your name next time I'm trying to get into one of these places?
I'll let you know.
All right. Wow. All right, let's check in on the markets here. The stocks pretty much holding their gains from where we started the day, at least on the broader indices there. You take a look at some of the individual movers, Sonali, and of course, I'm really focused right now on Netflix, that they're going to report after the bell on my show. You know I have a show too, right?
Yes,
Called
I'm
The
looking
Close.
forward to you breaking it down later.
Are you going to stick around for that too? We can go wire to wire.
I'll be watching from
home.
somewhere else, maybe a fancy restaurant. Anyways, U.S. Bancorp down. We were watching financials still this earnings season. The banks have been running up, but they have missed on net interest income estimates in the first report under a new CEO. And we've been watching this as well. Archer Daniel Midland, I think this is a really interesting ripple effect of Coca-Cola's decision to use real cane sugar, they say, instead of the sugar that is more tied to corn syrup, which Archer Daniels is behind.
Yeah, and there's some great history with ADM and the whole move to high fructose corn syrups back in the 70s and 80s that I don't think we have enough time in this show, but if I were Matt Miller, I would just keep going and blow the break.
Romaine is also on the close, so we can get into it more that as well.
All right, and of course, we will have full coverage of those Netflix earnings after the bell tonight, but meanwhile, open interest continues with a closer look at what those earnings might look like, a conversation with e-commerce analytics firm McMack on what they're seeing with regards to a surge in clients willing to work with Netflix. That's coming up next here on Open Interest. This is Bloomberg.
And when we look to Netflix reporting after the bell, we're going to be talking a little bit about advertising revenue to see how much exactly they could squeeze out of that pie. An e-commerce analytics platform, Micmac, works with 2,500 customer product advertisers, and CEO Rachel Tipograph says that her customers didn't advertise on Netflix until 2024, 2 years after it got into the ad business. Micmac CEO Rachel Tipograph joins us now at the desk. This is an interesting question for Netflix, especially as it gets further and further into live entertainment as well. What's the potential for them to get much bigger in the space?
The potential's massive because it's honestly really small today. When you think about Netflix and the opportunity to advertise in CTV, there's been more established players. You have Hulu, you have Peacock, you have HBO Max, the list goes on. And so beyond that, you also then have the DSP side. Trade Desk, Amazon, Microsoft Xandr. The space is actually highly competitive and really established. So the only place for Netflix from this moment in time is to go up.
What does engagement, though, look like when we talk about advertising on a platform like a Netflix or really any streaming platform relative to maybe advertising on social media, where the way that people interact with not just ads but the posts themselves is just a little bit different?
Yeah, it's early days in interactivity in CTV. If you're going to look at anyone and say they figured it out, it will be Amazon. And it's because Amazon not only owns the demand side, and now they have a content play, but they also own commerce. So you have the opportunity in that environment to truly have full funnel marketing from inspiration all the way down to conversion. When you look at the rest of the CTV players, the user experience overall is still kind of clunky when it comes to interactivity. It's either QR code or using the remote or maybe even the mobile app from a second screening standpoint. Netflix, again, it's early days when it comes to interactivity, but they are making investments even beyond CTV advertising in an environment like gaming.
You know, my family, while we're watching streaming services these days, get really frustrating because you're paying for the streaming services and now you're getting the ads anyways. Is this going to be more and more of a reality for Netflix viewers years down the road?
Absolutely. I think we all know this. The reason why Netflix started to get into the advertising game is that they capped out on subscriptions. And they're now not even reporting that as a metric, right? They're looking at revenue per user. So every single user, how are you going to monetize them? The easiest and most profitable way is through advertising. If you think about the opportunity, depending on what you want to think about as the overall space, you could look at online video, you could look at CTV, you could look at programmatic video, you could look at social video, you could look at linear TV. If you size all of that up, it's a $250 billion TAM.
So if you're an advertiser, would you rather advertise on Netflix or on YouTube?
Very different questions. YouTube, you have more reach, you have more targeting capabilities, you have real-time optimizations, you have measurement. Netflix right now, I would say if you were to compare them to YouTube, they have premium content assets. So if you're a brand that wants to be associated with those premium content assets, great audience. They also have certain rights when it comes to live streaming, when it comes to events, but so does YouTube. I think if you're a brand that's really conscious about every dollar and making it work the hardest, the Netflix CPM is more expensive than the YouTube CPM because there's just more YouTube inventory available.
Do you have any insight, though, into how much information Netflix is sharing with advertisers with regards to what we're watching, how long we're watching it? Because they've been pretty stingy with that data, at least making it public to investors. I mean, we kind of have a general sense, but it's very surface level.
Yeah, I think it's early days with Netflix in terms of building out their ad platform capabilities. In order for advertising to scale, they're going to have a self-serve ad buying platform that can optimize in real time and can report on analytics in real time. That's something that they've been public about, that they're focused on building out. And once they build that out, I'm sure we'll start to see additional scale. But that's really required to compete in today's market.
There are a lot of people that have questioned whether they have the true capabilities to do that. I mean, we know they have the deep pockets, but there's an expertise there. And that's not something you just flip a switch and somehow you magically figured it all out.
Yes and no. You go through an assessment, build, buy, partner. Initially, their entry was to partner with someone like Microsoft to help them accelerate in advertising. I mean, Microsoft is one of the 5 biggest players in advertising. Over time, they might choose to let go of that relationship because they'll have time to build out the assets themselves. But if they want to make a big splash really quickly, partnership is truly the angle right now.
I want to talk also about the food chain here when it comes to these big content distributors versus the advertising community and a big middleman, Trade Desk, set to join the S&P 500. But there are members of the analyst community who look at this relationship and ask how much it could hold up. Yes, they're a massive player in this game, but is there a chance that those content companies can get more and more leverage over Trade Desk?
Yeah, I think the question is, does Netflix want to own the pipes? Amazon decided that they want to own the pipes. They have a DSP. Trade Desk is a DSP. Microsoft Xandr is a DSP. The opportunity to scale your business beyond the assets that you have to monetize is in the DSP space. So right now, Netflix is still just figuring things out. Over time, they might actually say, we want a DSP. And if they do that, then they would become a competitor to the Trade Desk. But if Netflix is trying to get ad dollars right now, the path of least resistance is to partner with someone who is a DSP like the Trade Desk.
So how long do you see this time horizon playing out to the extent that they create a rift amongst each other? When does that actually happen? Is it 5 years down the road? Is it 10 years? Is it sooner?
I mean, the speed of innovation right now is faster than ever before, right? We are living in Moore's Law. So if I'm Netflix, like, you got to figure this out in the next 12 months if you want to capitalize on this opportunity.
All right, Rachel, great conversation. Great to meet you. McMack founder and CEO Rachel Tipograph. A look at the ad tech business maybe that Netflix is building out. And just a reminder, full coverage of Netflix's earnings report after the bell tonight on The Close. Meanwhile, open interest continues to roll on with a closer look at President Trump denying plans to fire Fed Chair Jerome Powell as he ramps up the campaign against him. We're going to get the latest from Washington when we come back after the break. This is Bloomberg. The pressure on Fed Chair Jerome Powell to cut rates or step aside, that continues. The President of the United States saying he's not planning to fire Powell, but did add he, quote, wouldn't rule anything out. Joining us right now is the co-host of Bloomberg's Balance of Power, Kayleigh Lines, talk a little bit more about this. And Kayleigh, we should just be very clear here. This is more than just the president. It's Bill Pulte. It's Kevin Warsh. It's Kevin Hassett. It's a whole host of names that seem to be making a case that Powell should maybe I don't know, leave before his 10 years up? Is there any sort of sense here that when Trump says he's not planning to fire Powell, he has no idea where all these reports are coming from? Is there some reason we should believe that?
Well, the president also didn't entirely rule out that Powell could still be forced out of the job, Romaine. When he spoke with reporters in the Oval Office yesterday, he said it's highly unlikely that he will fire Powell, but that he still sees a possibility he will have to go for, quote, fraud, as officials in the administration are alleging that there may be fraud around the renovations to the Federal Reserve buildings here in Washington. That is the narrative that is being, of course, propagated extensively by the FAA director, Bill Pulte, who you just mentioned. We spoke with him on Balance of Power last night, and he is adamant that the Fed chair should resign, and told us repeatedly that he's hearing that Powell is considering resigning, though he wouldn't say exactly where he's heard that, but that is coming word of mouth from people, including from inside the Federal Reserve. He also told us that he's confident Congress is going to open an investigation into the refurbishments of the Federal Reserve building and whether or not Powell was deceptive in his answers to Congress in testimony earlier this year. So by no means is this story over, and by no means is the president signaling he's going to stop putting pressure on the Fed chairman to lower rates. He was at it once again on True Social in the aftermath of today's strong retail sales data, saying too late, look at the data, lower the rate, essentially to paraphrase what the president posted. But when we consider this fraud question, Romaine and Shanali, it really is a matter of whether or not the administration may be searching for cause here, knowing that legally there are protections for the Federal Reserve and specifically for Fed governors who can only be removed by law for cause. So this may be an effort to drum up cause here, but it still could result in a massive court battle if and when the president were to decide that while he's not planning on it for now, he does ultimately want to fire the Fed chair.
How much is the president paying attention to the bond market as the Treasury Secretary is? Because you have, for example, TD Securities calling the removal of Powell as a low probability but a high impact event. And they say that in that event, they would expect investors to price in higher longer run inflation, higher term premium, more near-term Fed rate cuts, hence lowered front-end rates, but increased market volatility and a steeper yield curve. So perhaps higher long-end rates. And it's that 10-year that the Treasury Secretary is watching. What do you make of this concept that the president is floating some trial balloons here?
Well, Shanali, we know that President Trump has paid close attention to the bond market in the past, including when we saw those incredible gyrations in the aftermath of Liberation Day back in April, which he noted as queasiness in the bond market and helped spur his decision to offer a delay in those tariffs actually being implemented, which, of course, we have since seen delayed again. But to your point on how this actually could result in rates being higher at the long end, it is counterintuitive to what the administration is trying to achieve. What Scott Bessent has said, what President Trump has said, is that they want borrowing costs to come down, including to finance the interest on the debt here in the United States, but also for things like mortgage rates that are heavily felt by the American people. And it could have an adverse effect if you were to see disruptions in the independence of the Federal Reserve sending long-end rates higher. They're not necessarily going to get the lower borrowing costs that they want. So it's unclear whether or not there are voices in the president's ear, like Scott Bessent or others in his economic circle, that are signaling that to the president, and whether that factored into the president pushing back against reports that he was considering firing the Fed chair yesterday. But we know that this president has a long history of paying attention to financial markets.
Kayleigh, we thank you so very much for your time this morning. Catch Kayleigh on Balance of Power at 1 p.m. Eastern, then again at 5 p.m. Of course, the story changes a lot in the course of a day. And speaking of today, let's just get a check on these markets, how they're faring. The S&P 500 still up about 0.3%. We're below that 6,300 level that we hit a little earlier in the week, Romaine. The NASDAQ 100 flying about 0.5%.
Yeah.
We spoke to Stuart Kaiser at Citigroup a little earlier this week. He was saying that clients are starting to call him on the days where you're seeing 0.5% move.
Yeah.
So that's how sensitive this market is to upward pressure.
Very sensitive, and that bit of that grind higher, and maybe that changes tonight. Obviously, Netflix, a big component in the NASDAQ, so we'll see what happens after they report later this evening.
And coming up tomorrow, Monetta's Chief Global Market Strategist and EFIT David, plus Lori Heinel, Global Chief Investment Officer at State Street Investment Management. Stick with us through the close. This is Bloomberg Open Interest.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, TSMC, the world's biggest contract chip maker, gets a big boost from AI demand. Plus, Uber teams up with EV maker Lucid and self-driving tech startup Neuro to launch a robo-taxi fleet. We'll speak with the CEO of Neuro. And what to expect from Netflix earnings today. Will it be a blockbuster or a bust? Let's get to that curious three-way deal that is between Uber, Lucid, and Neuro. Basically how it works is Lucid's going to provide the cars, Neuro the self-driving tech, and Uber's going to pay for everything. We're going to get a lot more detail on that later in the show. But look at shares of Lucid, up more than 36%. This is a big move upwards, and we need to find out why. The big story in global technology is TSMC, the world's largest and most important contract chip manufacturer. These are the US-listed shares, ADRs up 2.8%. Basically, upgraded the growth forecast on the top line to 30%, saying that there is hot AI demand right now. But interestingly, some headwinds from currency, which we can dig into. Luckily, Bloomberg's Ian King is here for more, who leads our coverage of the semiconductor industry. So actually quite a simple story, that in the numbers in the period gone and what they said about what's to come, AI demand is everything.
Yeah, I mean, anytime you're saying 30% up, you're saying we're having a good year. But it's important to point out that the stock didn't do much locally. And why was that? Well, because guess what? Some analysts were expecting even more. So fantastic, obviously a great derivative for here, but maybe not as fantastic as some had expected.
TSMC's business is really interesting because basically 2/3 of it is high performance compute, the chips that go into data centers. Historically, it was smartphones. So even though the proportions have changed, I see both of those divisions growing.
Yeah, both of them did well. As you said, high-performance computing, which is basically NVIDIA's chips, AMD's chips, anything that any of the hyperscalers design themselves. That's 60% of its business. That's growing well, and that's really what the focus is right now. That's what everybody wants to see. Is this story that is defining technology still continuing? And the answer was absolutely yes.
So TSMC is like the crown jewel of Taiwan. It's their most important entity and company. They have a big footprint there. But what was really interesting to hear about was the headwind from currency. As I understand it, they book all their revenue in US dollars, but their operating costs are in Taiwanese dollars. What did they say about that and how it's going to impact them?
Yeah, I mean, this is obviously a complex story because they're in a distributed supply chain. You've got the currency headwinds. You've got concern about what's going to happen to that supply chain. Are they moving? Are they raising their expenses as they build factories here in the US? What's going to happen with tariffs? So all of these kind of economic uncertainties, and currency was one of them, factored into, I think, this kind of conservative, or what was considered conservative forecast, but conservative in their context, which is pretty amazing still.
Okay, Bloomberg's Ian King, who again leads our coverage of the semiconductor industry. Let's get more of a broader markets perspective and go out to Jay Jacobs, BlackRock US Head of Equity ETFs. You and I have talked about infrastructure so much, but I almost consider names like TSMC and ASML as being kind of soft data sets rather than kind of hard data sets. ASML gave us one signal and then TSMC gave us another. As somebody that looks at their exposure to this AI supply chain, what did you make of it?
Well, I think you really have to go up to kind of the higher order of capital expenditures, which is impacting so many different semiconductor stocks. If you look at the top 4 builders of infrastructure this year and combine them with energy and utilities companies, all of that CapEx equals the rest of the S&P 500 combined. So you're just seeing so much investment from semiconductors to energy and power sources across this AI megaforce that it's really providing a ton of ballast to these stocks as we enter into earnings season.
I think we'd agree that AI is having a profound impact on markets. That's probably an understatement at this point. But when you consider the ETFs you're managing, where do you see the enthusiasm, or where do you see movement of investors wanting to be exposed to what's happening?
Well, if we look more broadly at what's happening in the markets this year, themes are really displacing sectors as having the most explanatory power of what's happening around us. Artificial intelligence and baskets of stocks related to that explain a lot of what happened in February. If you look at geopolitical fragmentation and companies in the infrastructure and defense space, that explains a lot of what's been happening since April. So themes themselves have a ton of explanatory power in the markets. To your question, where